Do you know how to beat the market? I mean, how difficult can it be? You just buy low and sell high, and maybe do it better than everyone else. And yet, when we look at the actual data from retail trading accounts, the reality is almost the exact opposite. Running when afraid and being greedy when times are good is a biological instinct. We are wired to follow the herd to survive. So in reality, our psychology tells us to buy when we feel safe. The problem is, we usually feel safe when prices are high, and we're afraid when the prices are going down. And during a bull market, we feel very safe. Whenever the market is making history and keep reaching all-time highs, no matter the wars, tariffs, or whatever is happening in the world, sometimes it feels like the stock market will just keep going up until it doesn't. And it makes you wonder, what are the actual odds that in the long run, you will not lose money in the market? After almost 20 years in the field, I can tell you this: there is no silver bullet. But if you understand how markets really work and why most people fail, you can avoid the mistakes that cost investors years of lost returns, or wipe them out completely. Invest now, live rich, retire young, or at least that's the idea, right? Because if there is one thing our generation is doing more than others, is personal finance. Stocks, crypto, ETFs, mutual funds, we don't just hand money to someone else to manage. We do it ourselves, and with one dream in mind: financial freedom.
Financial independence is the option to retire. Many people who are financially independent choose to go on to start businesses, build empires, continue working, work lifestyle jobs, work part-time. Some do truly live a early retiree lifestyle, but financial independence is the option.
But let's be honest. Remember the late 90s? That world of Britney Spears, MTV, and the X-Files, but also of the dot-com crash. Not everyone wants to remember when people were getting rich on tech stocks before the Nasdaq rediscovered gravity. So, in the 90s, the stock market was skyrocketing, and the rise of the internet was attracting huge investments, just like AI companies now, or whatever the next big thing happens to be. Everyone was jumping on board to make money. In fact, in the late 90s, you'd have online companies offering all kinds of services. Take webvan.com, for example. The company was delivering groceries. Nice and simple, why not? Except, the company had a totally unrealistic business model. After burning hundreds of millions, they eventually admitted that they had no idea what they were doing. Another one is pets.com. A company that was selling stuff like cat litter and dog poo scoopers managed to raise $80 million. At some point, they even were able to afford a Super Bowl commercial.
Ooh, no, baby, please don't go.
Really, markets were willing to invest in any internet company, even if it was run by a sock puppet. And the result is that between 1995 and 2000, the Nasdaq index went from 1,000 points to 5,000, a rocket fueled by greed. So many people were starting to believe that living rich and retiring young was just around the corner, until the bubble exploded, and Nasdaq dropped by almost 80% until it discovered the bottom. So, in a scenario like this, the market is crashing, what do you do?
Bad day.
Bad day for you?
Another one, yeah.
Yeah, I know.
Too many in a row.
Is it a good time to invest long term? Do you trade the swings? The answer, of course, is it depends. But maybe let's clear up one big misconception. Investing and trading are not the same thing. In fact, they're almost the exact opposite. Look at these two men. On one side, you have the investor, the Oracle of Omaha, Warren Buffett. His philosophy is value investing. It's boring, it's slow, it's based on the idea that a stock represents a piece of a real business. If Buffett likes a company, he buys it and holds it forever. He ignores the noise, he's betting that over 10 or 20 years the business will grow. On the other side, you have George Soros. Soros is a trader. He doesn't necessarily care if a business is good or bad. He cares about reflexivity, how the market psychology distorts prices. In 1992, he didn't invest in the British pound because he loved England. He shorted it because he saw a flaw in the system. In other words, he bet against an entire country's central bank by selling their currency using a lot of leverage. And he won.
Bundesbank was basically egging on the speculators to speculate against the weaker currencies. And we took our cue, actually, from the Bundesbank.
He made $1 billion in a single day. Isn't it amazing? Of course, you'd look at Soros and think, I want to do the same. Who wants to wait 20 years? But Soros had an army of analysts, billions of leverage, and a deep understanding of global macroeconomics. If an average retail investor or trader tries to trade like Soros from their laptop, they aren't the hunters chasing $1 billion. They are a prey of a multi-trillion-dollar financial industry. And the worst part, intelligence alone is not enough to save a trader from making big mistakes or even help them win. And what does winning even mean when it comes to stock market? If I told you that I could make you a 10% return on your money this year, would you take it? Most people would say yes. 10% is amazing. Banks pay you near to nothing compared to inflation. But in the world of professional finance, 10% return tells me absolutely nothing. Because if the overall stock market went up by 50% that same year, and you only made 10%, you didn't win. You actually lost. You see, making money in the market doesn't mean beating the market. Beating the market means making more money than a benchmark after you account for all the risk, the interest, and the fees you paid to trade. This is called generating alpha. In other words, beating the market, generating alpha, means earning more than a comparable, well-diversified market benchmark, like the S&P 500, for example. And this is where the psychological traps happen.
You actually have to train the brain because the brain is biased to seek certainty. It wants to be right. It's survival value that's been built into our system for 6 million years.
When the market is booming, it feels that almost everyone makes money. You buy a tech stock, it goes up. You buy crypto, it goes up. You feel like a genius. But a rising tide lifts whole boats, even the leaky ones. If you spent hours researching stocks, stressing over charts, and paying trading fees just to make 10%, when you could have made 15% by literally doing nothing and just buying an S&P 500 ETF, then all that work you did actually cost you 5%. To earn at least something in the market, you do not need to beat the market. You just need to capture a fraction of the market's return. The problem is, human beings are competitive. We aren't satisfied with average. We want to be the outlier. Financial freedom, live rich, retire young. We want to be the one who finds the next Apple before it's Apple, or Nvidia, or Tesla. We want to beat the market and do it consistently. But as we're just about to see, the opponent you're trying to beat isn't just hard. It's playing all the ultimate difficulty level in a game where intelligence may not even matter. Isaac Newton was arguably one of the most brilliant minds in human history. He defined the laws of gravity, he invented calculus, not someone you could easily consider a fool. But in 1720, he lost almost his entire fortune speculating in the stock market. It happened during the South Sea bubble. The South Sea Company was the Nvidia of the 18th century. It had a monopoly on trade and a narrative that everybody believed in. Newton bought shares early. The stock went up, he sold, made a good profit, and it was a rational, disciplined trade. But then he watched. He watched the stock keep climbing. His friends, people with a fraction of his IQ, were getting richer and richer. And eventually, the psychological pressure became too much. The dreaded fear of missing out. So FOMO overrode his analytical discipline. Newton bought back in, and he did so with a bang. But he did so almost at the very peak. And shortly after reality set in, the bubble burst. The stock crashed. And Newton lost. He later allegedly said, I can calculate the motions of heavenly bodies, but not the madness of people. In that market, his IQ didn't make a difference. Isaac Newton, the man who literally calculated the mechanics of the universe, couldn't beat the market. Why? The answer lies in something that economists call the efficient market hypothesis. It's actually one of the most uncomfortable and hard to accept concepts in finance. Because it strips the investor of their main psychological defense, the belief that they are more intelligent than the mindless crowd of the market. But to understand this, let's now go to 1906, about 200 years after Newton made his infamous trade. A British scientist named Francis Galton was at a country fair. He watched a contest where people tried to guess the weight of an ox. 800 people entered. Farmers, butchers, laymen, some were experts, some were just regular drunks. Galton assumed the crowd would be wrong. He expected the average guess to be way off because, well, most people don't know anything about oxen. By some reports, when he averaged all 800 or so guesses, the result was 1,197 pounds. The actual weight of the ox was 1,198 pounds. The crowd was off by 1 single pound. This is the wisdom of crowds. And the stock market is just a giant digital version of that country fair, where everybody's opinion is reflected in a matter of microseconds. Every single time you buy a stock because you think the price is low, you're betting that you know the weight of the ox better than the millions of other investors' algorithms and hedge funds that set that price. You're betting that the crowd is wrong and inefficient. But is the crowd inefficient? Economists have actually categorized market efficiency into 3 distinct levels. Think of them as cheat code settings in a video game. And the lower the level, the more difficult it is to beat the game. Level 1 and 2 efficiency mean that all public information gets priced in almost instantly. Stock prices, public news, whatever is out there. If you think you found an edge by reading the Wall Street Journal or spotting a chart pattern, that edge is already gone. High-frequency bots traded on it in seconds. The edge you think you had was already exploited millions of times before you even knew it existed. Years of research support that most developed markets are level 1 and level 2 efficient. But there's a third level. If markets were level 3 efficient, the prices would reflect everything, even information that isn't public yet. Something like a failed drug trial or a fatal flaw in a car safety system that didn't hit the news yet. If level 3 holds true, then nobody, not even the CEO of a company, can beat the market consistently over time. But we know that's not entirely true, don't we? Because while you and I are stuck at the country fair guessing the weight of the ox, some people have already seen the number on the scale the night before. If markets are efficient and prices reflect all available public information, then how do you explain this super investors? How do you explain the fact that members of the US Congress on both sides of the aisle seem to be the greatest stock traders in human history? In 2023, a report showed that some of them achieved returns that would make Warren Buffett blush.
It found that out of 100 trading members, 33% beat the market, which itself was up 24% last year.
Are they geniuses? Are they just lucky? Or could they have some informational advantage? I'm not making any assumptions, but if you have information that isn't available to everybody, you aren't guessing the weight of the ox. You know the weight of the ox. And what if you acted on that information and won big? Well, in the financial world, this is called insider trading. For you and me, we've proven it's a felony. But some players would justify their abnormal returns through their supreme analytical skills or unique insight or just pure luck. The problem is, those assertions almost never hold under scrutiny. So, in other words, the theory suggests that there are only two ways to make massive beat-the-market returns. You either possess some insider information, or you are incredibly 1 in a million lucky. But over and over again, I will meet somebody who will say, Alex, that's not true. I look at this chart, and if I buy here and sell there, I win. I just need to develop a model and apply it consistently. But that's our minds playing tricks on us. By looking at the past, we think we know the future. Or at least we can predict it well enough. So maybe let's do a little experiment. Look at this stock. I won't even trick you into anything. This is an actual Apple stock performance. I just won't tell you which year. Here, at this entry point, do you buy, sell, or hold? Okay, how about now? And how about here? Did you guess all three trades right? You know what's funny? Even if you guessed all three trades right, you would have still not beaten S&P 500 in that same period. To beat the market, not only do you need to predict the future, you need to predict the future better than the millions of other humans and powerful machines trying to do the same. In 2007, Warren Buffett, the greatest investor of all time, was looking at the hedge fund industry. These are the masters of the finance universe, the smartest guys in the room. They are the ones who charge 2% management fee and take another 20% of the profits above a certain threshold because they claim they can navigate the market better than anyone else. Buffett was convinced this was nonsense. He believed that after fees, these active managers could never beat a simple, boring, passive S&P 500 index fund. So he issued a challenge. He bet $1 million that a simple S&P 500 index fund would outperform a basket of hedge funds over 10 years. A firm called Protégé Partners accepted the bet. They selected a bunch of funds they liked, the absolute cream of the crop. These guys could short stock, use leverage, trade derivatives, swing trading, day trading, whatever. They had PhDs, supercomputers, and Buffett, he needed to do almost nothing. He bought the index fund and probably went to get his favorite burger from McDonald's and maybe a glass of Coke. But the bet started in 2008, right as the market crashed. At first, the hedge funds actually did better. They could hedge against the crash. But as the years went on, the fees started to eat into their returns, and the market efficiency kicked in. By the time the bet ended in 2017, the results were incredible. The hedge funds returned about 36% after fees, and Warren Buffett's boring index fund returned 126%. Buffett outperformed the smartest guys in the room by almost 4 times, doing literally nothing other than diversifying the heck out of his portfolio at as low of a cost as possible. If you buy one company, say Tesla, you're taking on company-specific risk. What if a battery explodes and somebody gets seriously injured? The factory might burn down. If that happens, the stock will react viciously, and you could lose a lot of money very quickly. Anything could happen to that one stock. Like, what if Elon decides to get into politics? Oh, wait. Right. Meanwhile, S&P 500 has 500 companies in the index. If something happens to Tesla, and that's only Tesla's problem, that's only 1/500th of the index. The index might barely notice. If one company fails, it's just a blip. If a sector crashes, the others could easily balance it out in the index. That's what diversification is about. It spreads the risks, balances out the ups and downs, and combines this massive collective market wisdom that is virtually impossible to outsmart consistently. So, if you can't beat the collective wisdom, what do? Well, maybe the smartest move is not to fight it, but to simply join it. To stop trying to buy the needle and just buy a piece of the whole haystack. And to protect ourselves from our own biology, the fear and greed, what if we take the decision-making powers away from ourselves? In the long run, automated, consistent, emotion-free investing in a diversified asset will almost always outperform adrenaline-rich stock picking. If you zoom out and remove all emotions, the market stops looking like a roller coaster and starts looking like a system. In 1 year, anything can happen. But in 10, 20, 30 years, that system has a pretty incredible track record of building wealth. Is it actually that simple? Just buy an ETF and forget about it? And by the way, if you aren't sure what an ETF actually is or how it differs from, say, a stock or a bond or a mutual fund, I put together a short free guide that breaks all that down. You'll find the link in the description below the video. But while investing doesn't necessarily need to be difficult, planning and managing wealth is a completely different beast. The more wealth you have, the more important it is to pay attention to taxes, estate laws, risk, allocations, time, and so many other factors. All that requires a level of professional precision that goes far beyond just picking the highest performing ETF. But where's any fun in that? We don't pick stocks, we hire somebody to do wealth planning for us. What do? Yes, I know. Stock market is not that huge exciting casino, where all you need to do is put all your chips on the right color before everybody else does. But the market requires patience, and it actually rewards discipline and time. Investing should never be about being the person who finds the next Apple or Amazon or Nvidia. Of course, it doesn't hurt if you do, but it's much more about being the person who survives the crashes and stays in the game long enough for compound interest to work its magic. Yes, it may not be the path to living rich and retiring young, but it's almost certainly not a bad path to retiring rich. Thanks for watching. If you enjoyed the channel, please consider subscribing, and see you in the next video.